everyone, and welcome to the premium video newsletter for Friday, September 6th, 2013. Fortunately, it's Friday and the weekend is coming up. This has been one of the most interesting and stressful trading weeks in a very long time. Let's start off with the fundamentals and jump into the technicals from there. U.S. employers have yet to start hiring aggressively, a trend that the Federal Reserve will wait in deciding this month whether to slow its bond buying and, if so, by how much. Employers added 169,000 jobs in August, fewer in June and July than previously thought, according to the Labor Department. Combined, June, July, and August amounted to the weakest three-month stretch of job growth in a year. The unemployment rate did drop to 7.3%, the lowest in nearly 5 years. But it fell because more Americans stopped looking for work and were no longer counted as unemployed. The report adds up to a mixed picture of the U.S. job market. Hiring is steady but subpar. Much of the hiring is in a lower paying occupation levels, and many people are giving up on the job market in frustration. The job picture is sure to weigh heavily when the Feds meet September 17th and 18th to discuss whether to scale back its $85 billion a month in Treasury and mortgage bond purchases. Those purchases have helped keep home loan and other borrowing rates ultra low to try to encourage consumers and businesses to borrow and spend more. While economists still believe the Fed will begin cutting as early as a few weeks from now, there are strong mixed signals as to how much they will cut and how often. This is the only unknown at this time, and something the market has not been able to discount as of yet. Technically, the broad market rallied during the majority of the trading session, as most traders took the disappointing employment number as hope that the Feds will not discontinue the stimuli program, or at least do it very gradually. I believe most of this is false hopes, but the market is always right, and we have to go with it one way or another. Further examination into the subsectors that make up the broad market shows us that the retail sector is still struggling below the 50-day moving average and is having difficulty rallying even in light of potential news that the Feds won't be cutting the stimuli as soon or as much as we initially thought. To me, this is not a bullish picture. To get further confirmation, I wanted to look at the financial subsector, and I'm seeing the same type of picture. Not only are we below the 50-day average, but the ETF has a bearish flag pattern as well. Both of these subsectors are not giving me a lot of confidence to the upside in the broad market. Lastly, I wanted to check the transports. And although we have somewhat higher sloping trading range compared to most subsectors in the broad market, the transports did not finish the week above the 50-day moving average. This tells me that the broad market is still bearish, and we need to see some of the subsectors really rally in order to push the market higher. If we don't see the broad market well above the 50-day moving average by the end of next week, we may be officially in a distribution stage by that time, which is another way of saying a bearish market cycle. Gold futures this week saw extremely volatile trade, finishing out this Friday afternoon up $14 at $13.87 an ounce, and traded as low as $13.58 this morning before the U.S. unemployment report came out. Tensions in Syria as well are starting to flare up, and it looks like President Obama is determined to have some type of strike against Syria, which is also lending support to gold prices this afternoon. Another market that's reacting similarly to the gold market is the crude oil market. We heard earlier today that Putin told U.S. he will support Syria even if U.S. attacks. This creates even greater political friction and will certainly cause higher oil prices if, in fact, we do attack Syria. Right now, we have to be careful because volatility in the crude market is high again. And when that happens, there's a lot of emotions in the market. All the news stations are reporting that crude hit a 2-year high. And we did if you look at the closing prices. But I always look at the daily range. And the 2-year high is really at the 112 level. So be careful when you listen to the news reports. They have a way of twisting the news to create more stories. My suggestion is to sit on the sideline for now. The island top we saw did take us from the 112 level to the 104 level within a few days. And these are the two levels we carefully have to focus on right now. If we break either level, we're going to see some momentum. The only way I see us staying at the lower level if something really cools Syria off within the next few days. Otherwise, I think we may be heading above the high very shortly. And if we do, we're going to go higher, much higher. If you recall yesterday, we broke the low on the bond market. I mentioned to you that the bond market is anticipating the Feds are going to stop putting money into the markets very shortly. And this is why interest rates are going higher. I also mentioned that if you're planning on going short, you would get plenty of opportunity because the bond market is very forgiving and range bound. Today we rallied above the expected 124.5 area, and I believe we can go to the 125 and even higher if next week US attacks Syria. Generally, interest rates do not go up during times of war. So we may see this taking precedence over the stimuli program, especially if we attack next week. I want you to be mindful of that right now because we have two very important fundamental pictures, and each has a totally different impact on the bond market. This will create extra volatility and friction due to the excess speculation that occurs when there's so much uncertainty. My suggestion is to wait till we figure out exactly what we're going to do in regards to Syria before moving forward. Even if we do attack Syria, it won't be a long-term invasion. So unless there are surprises, and with war there's always surprises, we will most likely continue drifting lower in the coming months ahead. Another market that's tremendously impacted by the current economic climate is the US dollar. The bond market is controlling the dollar right now because if bond yields go up, more investors and traders will be putting their money into the US market and taking money out of the foreign currencies. If, on the other hand, the US goes to war with Syria, the odds are strong that the Feds will continue offering support to the US. And that'll keep on prices low. And this will cause the US dollar to drop back down to the base. So the question is, where do we go from here? We have two important economic issues, the Fed stimuli and Syria. As I mentioned, this is an interesting time because I feel like we're in front of two doors. And if we open one door, we will go one way. And if we open the other door, we will go the other way. It's a very extreme position, but I think this is where we're at right now, and not just with the US stock market, but with the global markets as well. I will go over the setups and provide further analysis when I do my Sunday outlook for the week ahead. Have a great weekend and expect to hear from me midday on Sunday. Have a great weekend, everyone.